Hey guys, welcome back to Zach Going Fire. Today I'm going to do a net worth update. This is as of December 1st, and I'll be recording on December 2nd, but I took the numbers down on December 1st. So if you're new to this channel, I am a truck driver who plans on retiring next June 2026 at the age of 44. My wife has recently retired a few weeks ago from her full-time job. Now she works as a full-time travel agent, and we plan on traveling the world. So let's go ahead and dive into the numbers to get our net worth. And as I go along each category, I'll explain a little bit about my thinking about how we have allocated our funds. So this is the Wealth Plus app I have up on the screen with me, and you're seeing the credit cards that we have. And I did list some balances. We pay these balances off every month before they're due. So we had 127 on our IHG card, where we recently used that to get a hotel. We took a trip to the beach, and then we went out to eat a few times, and we went to Sam's for groceries and gas. And we also have the M1 margin loan for $3,043. So all of our liabilities come to $3,398. If you're new to this channel, just keep in mind this margin loan is something that I am using as a small percentage of my net worth just to exercise the muscle of borrowing money. And the reason why I have that is because I only pay about 5% interest on it, and I am making more than that with my investments, and I intend on just keeping it there. And when or if the market drops substantially in the first few years of our retirement, we can borrow a lot more against our assets and invest aggressively so that we can maintain our lifestyle. And we don't have to worry as much about the sequence of returns risk with that. So then we have our cars. So I keep my car balance depreciating every month by $100 a month. $14,400 is the current value. And Mindy's car, we look at the Kelley Blue Book value estimated for private sale, and we use the lowest of the numbers it gives you. So hers does fluctuate up and down a little bit. We plan on selling her car around April and adding that cash into the rest of our money. We'll keep my car through my retirement in June and up until we leave the country in November, when we plan on selling my car and putting that cash in with the rest of our portfolio. Next, we have Mindy's HSA. She has currently $745. It's not invested. That's just in a savings account, or an HSA savings, so it gets a small amount of interest on it. She has a traditional IRA, $14,907. We invest that money using Jason Kelly's 6 SIG plan, and I'll share the link for Jason Kelly's website below at jasonkelly.com. I use the same investment plan for my traditional IRA, 6 SIG, and we are using that because that's just a medium aggressive plan compared to his 3 SIG and 9 SIG, and it's a small amount of our overall net worth. Eventually we'll probably convert this traditional IRA into our Roth IRAs when we're retired. So Mindy has her Roth account, at $297,472. That's mostly invested in the income SIG plan. We're transitioning from the growth plans for Jason Kelly over to the income SIG plan. My traditional IRA is at $10,030. Again, that's with his 6 SIG plan. My Roth IRA is at $505,372. That's mostly in his income SIG plan. And when I say mostly, I mean it is 85% in his income SIG plan. We have about 5% in his 3 SIG, 5% in his 6 SIG, and 5% in his 9 SIG plan. We have the bridge account, which I call it our bridge account. That's a taxable brokerage account. And that's where over the last year, we put in a lot of money. When we sold our house, we put all the extra money we had into this account so that we can spend from this first in early retirement. And this is 100% in Jason Kelly's income SIG plan. My 401k at my company is $1,595. We are using Jason Kelly's 3 SIG plan for this account. I was contributing to, but I have stopped contributions simply because the company match, I will not be at the company long enough to get that match. It has to sit for at least 3 years. And so when I retire, I will roll this into my traditional IRA, and then later on, I will convert it to my Roth IRA. McLean HSA, I'm contributing about $50 per pay period to that, and I'll be using that for medical expenses down the road. That is not invested money, it's just earning interest. My HSA with Fidelity is from an old HSA that I had, and I've rolled it into a Fidelity so that I can invest the money, and that is invested using Jason Kelly's 6 SIG plan, and hopefully that will grow to much higher balance before I need to use it too much in retirement for medical expenses. We have a Fidelity account at $2,561. That's just a taxable investment account where we own 100 shares of Carnival. And I used to always call it I used to say that we get a discount with Carnival, and it's not really a discount. It's extra onboard credit. My wife, being a travel agent, always gets on to me for calling it a discount. But we bought those shares of Carnival when it was when the pandemic happened in 2020, and the shares had dropped down to around $6. So we only paid about $600 for 100 shares. So the next 3 accounts you see here, InKind, Upside, and PayPal, these small balances here of $415, $3, and $374, I use these accounts mainly just for discounts, and like InKind is a great way to get a discount on when we go out to eat. Upside is a great way to get discounts also when we go out to eat or get gas. And I use PayPal as a debit account and get discounts when we go out to eat. So why, you might ask, or you might wonder, why even keep track of these small accounts when you have as much money as what we manage? And basically, the reason I keep track of these is because I want to remember that the money is there. If you put money into something to get a discount, and then you forget that the money is there, you've basically lost the discount because you've not used your money. So I intend on using what I have there or transferring it out. I won't forget about the money there. Now the in-kind money, I can't ever get that back out as cash. That will sit there, but it never expires. We can use it towards eating out at thousands of restaurants. And if I can remember to, I will leave the links for these down below because we use it. Another thing is, why do I still try to get discounts everywhere I go and act like I'm poor, and even though I have over $1 million? Well, the answer is simple. $1 million is not what it used to be. Even though we have the money that we have, it's because of how we have been saving for so many years. And still so often I try not to be cheap, and we are trying to live a very wealthy life going forward. But I still try to make every dollar go as far as it can. When I can get 50% off or 15% off of going to a restaurant, then I love taking advantage of that, even though I will turn around the next minute and spend thousands of dollars to go on a trip around the world. It's just the lifestyle that we want to have. We have $43,197 in Capital One. That is broken down in Capital One into several different accounts we use as emergency funds as well as sinking funds for things like maintenance on our vehicles, insurance for our vehicles, utilities, rent payment, all of that kind of stuff. We have different accounts for and sinking funds, and a certain amount of every paycheck goes into those accounts. So the net worth now is at $1,080,481. And I was actually quite surprised this month with the way that the market bounced back during the last week. The first 3 weeks of November, if you were watching the market, you saw how it had gone down about 5%. It was actually on track. If it had continued that downtrend, it was on track to be the worst November for the stock market since the 2008 financial crash. So I was expecting to report to you that I was no longer a millionaire. But then the last week it did pop back up and we are slightly over a million once again. So we still are down about 1% from the prior month's net worth. We lost about $10,200. And I'll show you the charts here. Let me go find my largest account, the Roth account, at $505,372. It's up 35% year to date. Now, this crash back in April, one of the reasons why we were able to make so much money this year is that during that crash, we were mostly actually all in on Jason Kelly's 9 Sig plan at that time. And then when the market recovered here is where I started transitioning into his income sig plan. And now 85% of the account is in his income sig plan now. But over the last month, it lost about 1.5% of its value. It was about almost an $8,000 loss in the account over the last month. So that's it. That is our net worth update. I'm still planning on retiring next June, and let me know in the comments down below if you have any questions about our future plans, and let me know how you keep track of your net worth. Don't forget to hit like and subscribe, and until next time, let's continue to drive towards financial freedom.